Congratulations to you.
We have a minute. We can keep talking.
Okay, welcome everyone to the Finance Committee meeting for June 21st, 2023. It is about 6:30 p.m. Roll call, please.
Mr. Ghost,
Here.
Mr. Martin,
Here.
Mr. Grumney,
Here.
Mrs. Cooper, here, Mayor St. John,
Here.
Mr. Capel,
Here.
and Mr. Neff is absent.
Okay, let's go to the minutes from our last meeting. That was on May 17th of 2023.
Motion to approve.
Motion by Mr. Martin,
Second.
second by Mr. Grumney. Discussion. Roll call.
Mr. Martin,
Yes.
Mr. Grumney,
Yes.
Mr. Capel,
Yes.
Mr. Ghost,
Yes.
Mayor St. John,
Yes.
Mrs. Cooper. Yes. 6 yeas.
Thank you. Okay, for new business this evening, number one on the list, we do have some guests, and I believe Mr. Hennessy is here to introduce them. So go right
I'll do
ahead.
that. Thank you, Mr. Chairman. So we've been talking about the space planning project for a while now. We've invited this evening to join us for the Finance Committee, our financial advising team. So I'll introduce them. They'll be coming up to the microphone separately. But Brian Cooper from Baker Tilly, he serves as the city's municipal advisor. Chris Franzman is the city's bond counsel. And then Dave Collinsworth has served as the city's the owner's representative for the city during this project. So he's been engaged from the very beginning, assisting me primarily, making sure this project stays on schedule and hopefully is delivered on schedule. So for tonight's Finance Committee meeting, we're going to focus primarily on the financing of the project. Just to give you an update, we currently are in the bidding process. The bids are out. We have had 3 general contractors pull the plans and are considering submitting a bid. We did a pre-bid walkthrough earlier today with the contractors and the design team. So we may get some additional questions from them that may require an addendum, but at the moment we expect the bids to be submitted and opened June 29th, so next Thursday. So with that, what I'm going to do is ask Brian Cooper to come to the podium first. He does have a presentation. It's in front of you. We're also going to show it on the screen as well. Brian's going to talk a little bit about the financing, the impact of the financing, a little bit about Baker Tilly, and then also what we're doing with respect to the rating agency preparation. So.
Thank you, Daryl. Good evening, everyone. My name is Brian Cooper with Baker Tilly. I'm the city's municipal advisor. I've been in the business for 20 years and serve communities all across Ohio. Baker Tilly municipal advisors as a whole, we have a national footprint. We have over 80 municipal advisors. We're one of the leading municipal advisors in the country. The most important thing to know about a municipal advisor is we serve as your fiduciary throughout the bond process, much like your attorney protects you and has a fiduciary responsibility to you. We also have that responsibility to you on a financial basis. So I think that's important to know and understand. If you guys have any questions, feel free to jump in. I do have, if you want to advance the slides, this will take 5 minutes, maybe 10 minutes to go through it, but we have put together a plan of finance for the facilities financing. What you have in front of you is a bond ordinance. So if you have any technical questions about the bond ordinance, Mr. Crossman is here from Sweater Patent Bonds. But the plan of finance itself is to issue $3.1 million of general obligation bonds, is what we call capital facilities bonds. And we're looking at a 20-year term with a 2043 final maturity. As part of that sale process, we plan on going to S&P Global, which is a national rating firm that will assign a rating to the city and to the bonds, which will signal to the market your credit quality. And that will then dictate the interest rate that you'll receive on the bonds. The better your credit, the lower the interest rate investors are willing to accept. As Daryl mentions, for the municipal facilities, and the interesting thing about borrowing at the municipal level is in that bond ordinance, there's specific purpose for these funds. So when you go out and borrow 3.1 million, those funds will only be able to use for these facilities that we have planned. The bonds are tax exempt because you're a municipal issuer. That will allow you to get a lower rate than a corporate borrowing, for example. And the finance team is here before you, Baker Tilly Municipal Advisor, Squire Patton Boggs, and Mr. Collinsworth is serving as a city consultant to the city. Next slide, please. The most important thing on the plan of finance, there's a lot of ingredients, but one of the most important things are where interest rates are. This is a historical look back at the 10-year AAA MMD. The MMD is a benchmark index. And so you can see, you've heard a lot of news probably recently about the Fed and interest rates going up. If you've looked at mortgage rates lately, we also know those are going up. And so you can see that spike in interest rates starting at the end of 22. Historically speaking, right now we're in no different market than 2014, some bits of 15 and 2017. Rates are high or higher than they were historically. We can go to the next slide and show you the yield curve. This is the MMD plotted from years 1 to 30, and it shows with the dotted line where current MMD rates are as compared to 1 year ago and then pre-pandemic. So there has been a spike in interest rates. And interestingly, we have what's called an inverted yield curve right now, meaning that the short-term rates, years 1, 2, 3, 4, 5, and 6 are actually higher than years 7, 8, 9, and 10. That's an anomaly as well. Usually flags a recession. Nonetheless, the rates for the city's bonds are currently estimated at about 4%. That's all in, including all costs and expenses that are budgeted for. And we expect for the next 60 days, hopefully rates to be stable. Yes, sir.
Once this happens and we borrow the money, is the rate fixed or does it fluctuate?
It's a fixed rate. So
Okay.
once we go through the approval process with council, we go through the documentation and rating process, then we'll set a date for bond pricing. We actually have that date penciled in here. And that's the day that investors agree to buy, an underwriter agrees to buy, and the city agrees to sell. And on that date, the rates are set. And those rates will be set for the full 20-year term. And then the city will have an option, probably in year 10, we can set the option date whenever we want within reason, but the standard option is 10 years. So you'll have the fixed rate bonds for 10 years. And then after that date, you'll have the option to either pay them off or refinance them at a lower rate.
Good.
Is there a prepayment penalty?
The bonds, the bonds will be non-callable for anywhere from 5 to 10 years. The standard is 10 years. So even if you wanted to prepay the bonds, you can't do that before year 10.
Okay.
You could legally defease the bonds. In other words, set up a separate account to pay the bonds through that 10-year period. There's no penalty after that 10-year call date. They would be payable at par at 100%.
Thank you.
So does that non-callable also mean we don't have the ability to refinance either during that time?
Yeah, not really, not without getting into some advanced, techniques. Really, your options before that 10-year mark. And again, you could set it as short as about 5 years. So the first thing on your call option, the shorter the call, the higher the costs to the city. So what you want to do is you want to have a reasonable call date that's not going to cost you extra. And we do that analysis about a week before we price because rates are always changing. So we price it a week or two before we price. And then, so before the call date, you really can't prepay the bonds. Next slide is a summary of the plan of finance. We expect to price on August 16th with an expected closing on August 30. This is meant to coincide with the bid process, acceptance of the bid and the award of the construction contracting. This sheet is a S&P rating methodology matrix. So what we do as part of the rating process is before we go in and talk to the rating agencies, we look at the credit quality of the city to determine where we think your rating is going to be. And the rating is really broken down into three large groups or four large groups. The first is your economy. So your per capita income, your market value, your tax-based value, that accounts for 30% of your score. Your management, which we've worked quite a bit with Dana on, your financial management, it counts for about 20% of your rating score. Your financial measures, such as your liquidity, your fund balances, your financial performance over time, counts for about 30% of your rating. And then, believe it or not, your debt and contingent liability only accounts for about 10% of your rating. So we do a self-evaluation to determine where we think your rating will shake out with the rating agencies. And we think that you will rate out in at least the AA category. We have AA plus in this analysis. It could be as high as AAA, which is the highest rating category. We're spending some time now with Dana and Daryl on rating preparation to prepare for that meeting with the rating agencies. Going well. We've got a lot of information pulled together for them, and we'll sit down with them in a few weeks to go through the financial state of the city, also talk about local economic development projects and initiatives of the city. And then those rating analysts will go back to a committee and assign a rating to the city.
Question for you. So AA plus for a municipality this size, how is that highly favorable?
That's highly favorable.
The highest is AAA.
Highest, yeah. AAA would be the highest, and then AA plus would be the second highest.
So we should be happy about an AA plus.
Yeah. So a AA plus, anything in the AA category shows that the city has significant financial strength, very good financial management, has a strong and growing tax base, and has a generally low debt profile. If we rate out in the AA category, you guys should be very proud of that. And I think we will.
What variable, if you have been able to determine that, is keeping us from a AAA rating? Any idea?
The biggest variables for this city will be your local economy. So we want to see a bigger tax base, and we want to see better median incomes. So as you grow and as your median incomes go up, that will be a credit positive overall in the rating agency's eyes. Your financial management is great. Some of the things that you want with to score the highest you can in the financial management score is a capital plan, which I know the city's been working on, operational forecasting, debt policy, fund balance policies, all of these things Dana's been working on to either update or put in place as part of this process. So you demonstrate high financial management scores by doing those types of things. So the city is active in that. And then your debt profile for the size of city you are is a 2, which is the second highest score. So you still have a strong debt profile. If you issue more, that will probably drop to moderate, but that only counts for 10% of the score. And so even if you do issue more debt for capital projects in the city, it's unlikely to have a negative impact on your rating.
Thank you.
Yep. So the basic order of this type of transaction starts with authorization. That's where you guys come in. Like I mentioned, we have an ordinance before you, and that will go through the normal approval process. We can answer any questions about that ordinance. But that basically gives the authorization to issue the bonds, the legal authorization, and it kicks the approval of all the final bond terms to Dana, the finance director, to basically award the bonds once we're at the end of the transaction. So you give approval and delegate all other approvals to Dana as part of the process. Documentation, we are working on a preliminary official statement. This is a disclosure document that's used to market and sell bonds. Investors review this document, and it contains all of the material and information that an investor would need to know to make an investment decision. By the time we're done with it, it'll have the city's audit in it, a lot of information on the city itself, and then all the financial terms of the bonds. It'll probably be 150 pages when it's all said and done. And then once we have those two things, we'll go meet with the rating agencies. And then once we have the rating assignment, we'll go through the sale process where we offer the bonds, sell the bonds. And I believe what we're going to do is a competitive sale, which is where we offer the bonds for sale and we award all of the bonds to the firm that offers the city the lowest interest rate. And so it's a very orderly way to sell the bonds. And there will be a lot of interest in the bonds because of the city's expected credit rating and the fact that these are bank qualified. There's a lot of institutions that are interested in purchasing the bonds. So page 8, the final page is next steps. So we plan on meeting with S&P Global the week of July 24th. We'll receive the bond rating on or before August 3rd. And then we'll finalize the preliminary official statement and notice of sale, send that out to the market right after that. And the bonds will be sold and the interest rates will be set on August 16th. That'll give us 2 or 3 weeks to prepare for the bond closing, which will be on August 30th. And that's when the city treasury will receive the funds for the project. Any questions?
Any further questions? Mr. Mayor?
Who do you expect to be involved in the bond rating or the meeting with S&P Global? Who will be representing the city?
At a minimum, it will be Daryl Hennessy and Dana Steffen. We would also like to have you, Mayor, join us for that call. And then the financial consultants and legal consultants will also participate in that call.
Thank you.
Yep. You're welcome.
I see that we have a first reading this evening for the issuance of the bonds and sale of the bonds. I presume it would behoove us we're going to go the full 3 readings, correct? And we have time to do that.
We do. That's a good segue to inviting Chris up to the podium, talk a little bit about the bond ordinance itself and kind of what the process is, what council will be doing here over the course of the next 3 council meetings.
My name is Chris Ronsman. I'm a partner with Square Patton Boggs. I've done this for a while. I've been bond counsel to the village and now city for 25 years. The answer to the question that you're all asking is, did Brian and I coordinate our tire? No, really not. Well, we need to get Mr. Collins with the program here. Before I talk about the bond ordinance, I wanted to flesh out the question Mr. Ghost asked earlier about prepayment. Because for the longest time, we've been in a very low interest rate environment. And by historical standards, we're not actually in a high interest rate environment right now, although it feels like we are. But it still begs the question, can we prepay the debt? There's no legal prohibition on having the documents drafted in a way that you could prepay the debt. What I wanted to flesh out, and what Brian was alluding to, was that the market has an expectation with these types of obligations that the bonds will in fact not be prepaid for a period of time. And historically, that call protection period or no prepayment period, as Brian mentioned, is roughly 10 years. Okay. And by today's standards, you typically will see these types of obligations out in the market for 10 years without the option of prepayment. After the 10 years, the option of prepayment comes into play, and that prepayment is at par or at 100%. Back in the day, when I first started doing this a long time ago, to your point, Tim, there was a penalty for prepayment. So after 10 years, for example, the prepayment price would be 103% par. So there was a 3% penalty. And as the year would go by, it would tick down to 2 and then 1 and 0. Those days are past us, but we still do have this call protection period. Now, just to close that whole loop, could we issue bonds right out of the box that were prepayable? The answer is legally we could. What Brian will tell you, though, is that there would be an interest rate penalty for doing that. So the market, and Brian got into this and can flesh this out, but the market will look at this obligation, your rating, and then it will plot where it, being the market, expects coupons to be with a standard 7 to 10 year no call period. If we got rid of that no call period, then those coupons, those interest rates would actually go up because they would demand more. It would be more difficult to sell the debt. Okay. So I wanted to clarify that. So Brian did, as usual, an excellent job covering all the legal topics. I think you may have stayed at a Holiday Inn last night. So you do have before you a bond ordinance. So the legal authorization for this type of obligations for this body, this council, as the legislative authority of the city to pass a bond ordinance. The bond ordinance, I don't know if any of you have had an opportunity to read it. I hope so, because Daryl asked me to have a pop quiz. No, but in all seriousness, it's a very comprehensive document. It's much longer than most ordinances you see. I'm happy to answer any questions you have about it. But in general terms, what it does is authorizes the issuance of bonds in the maximum principal amount of $4 million at a maximum interest rate for a maximum term and for a specific purpose. There's a lot of maximums in there. The reason there are a lot of maximums is because years ago, we used to authorize the general sale, and then we would come back right after the sale and authorize the specific terms. Given that this body doesn't meet, every week, it became clear back in the day that that was difficult. So we've moved now to what we call not to exceed bond ordinance that authorizes maximum terms and delegates to Ms. Stephan the authority to set the final terms within those maximum parameters. Okay, so that's generally what this document does. Once it is enacted and beyond any referendum period, then we can go into the marketplace. While this body is reading the ordinance, presumably passing it, and we get through the referendum period, there are other things that we can be doing, as Brian articulated in his presentation, notably preparation for the rating presentation and getting the offering document, the preliminary official statement, in good form. So it's a dual track. This body taking its legislative action, and then the financing team doing everything. So those two efforts can converge at a single point, which is a bond sale where we lock down the interest rates. And then a couple of weeks later, we'll circulate a bunch of more very exciting legal documents that will be signed by members of senior staff and the mayor. And then we'll close the transaction.
So Chris, thank you for mentioning a not to exceed. If you remember, we talked a little bit about this at the last council or at the last finance committee meeting. I think we feel comfortable with a $3.1 million debt. That's the reason that Brian ran the numbers at that level. But yeah, the bond document says not to exceed 4 million. And I think it also says not to exceed 25 years. Although we've run it, again, the financial analysis was run at 3.1 million for a 20-year term. I think that's ultimately where we want to land. Just want to make sure we had the flexibility to move forward. You know, once we get the pricing information, you know, I mean, if anything shifts from that, we'll certainly have another conversation with council about that. So, all right. So questions for Chris?
A question and a comment. Back to Mr. Cooper's point. I think I heard you say we're basically going to have an auction of sorts when we go out and issue debt, and there's going to be a single buyer, a single firm. Is that correct?
So nowadays, what we do, Mayor, is there's an electronic platform. So we have the offering document that everybody probably has received that in the package. Has everybody, have the members of council seen the POS?
No, no.
There's a document circulating around that the administrator, I'm sure, would be happy to share. It's a very comprehensive document, goes into a lot of detail about the city, its finances, its economics, its demographics, the legal structure for the financing, some tax issues, federal securities law issues. At the back of that is something called a notice of sale. And that notice of sale informs prospective bidders about the terms of this transaction. That all will get bundled together after the rating agency presentation is complete with the rating. And then Brian's firm will submit it to an entity called Parity, which is an electronic dissemination service. And all of the investment banks around the country that are active in this space, that have customers that are interested in this type of debt, have access to Parity. And they will see the Sunbury transaction pop up on the calendar. They'll see it's for 3.1, they'll see it's for 25 years, they'll see the rating, then they have an opportunity on the sale date to submit a bid. And we'll get together with senior staff, and Brian and his firm will monitor the sale process. And when all the bids are in on that day, Brian and his team will evaluate all of the bids. Quite honestly, it's done very quickly by computer. And then once we have a low bid, we might tweak the debt service schedule a little bit to ensure we have level debt service based on the interest rates that came in. And then Dana will award the transaction. I'll prepare an award document that's consistent with the terms of the bond ordinance and the bid that came in, the winning bid that came in, and we'll award the transaction that way. So that is the current proposal for selling the bonds.
Thank you. And then the other comment I wanted to make earlier, just around prepayment. When you look at the bond rating, the S&P rating methodology, I mean, I'm going to break this down in simple terms. It rewards higher cash flow at a greater extent than it penalizes debt, I guess is what I'm saying. There's more of an emphasis on, keeping the cash on hand and fluid balances than it penalizes debt. I mean, just based on the percentages that I'm reading here. So I guess that what I'm saying is, I know these are all valid questions. Do we have the ability to prepay? But I think there's other strategies that we can employ to pay out the full term and probably take the best advantage of the bond.
Question, the double A plus rating, do you consider that with the 3.1 million number? Is that the sweet spot? Or is it possible we could get better terms at 4 million, for example, with the double A plus?
No, they're not. This is really Brian's bailiwick, but I'll jump in and let him jump in if I miss something. S&P as with all of the rating agencies, there are several others. As Brian went through in his slide deck, there is a list of criteria that they evaluate. It's a fairly transparent process. It didn't used to be that way, but it is now. And so they're not necessarily looking at the size of this financing to award your credit rating. Okay, if we had a lot of debt outstanding, they would be looking at the total amount of debt, and they do look at the total amount of debt, and they will look at the total amount of debt. But I don't think this size of a deal will be dispositive. They're really looking at the core financial and management issues that Brian articulated earlier when they're evaluating what rating box you're going to fall in. So it's not, is 3.1 too much or too little? It's what does the overall city look like from a total credit worthiness perspective? And that 3.1 million gets added on to your outstanding debt and so it's considered, but it would not be dispositive. And I suppose if we were proposing to do a $100 million financing, then yes, but where we are now, 3.1 to 4 or 5 or 6, no, it's not. It should not be dispositive of the issue.
Okay. And from an affordability standpoint, Dana, I think in a debt ratio before this, so right now we're, I think, around 11% ratio, give or take whatever happens in the market on a daily basis. And by adding this to our books, so to speak, what do we go to? 17, 18%?
I don't even think it was that high. I don't recall the exact percentage. I can look it up.
But that's still, I mean, less than 20, and Mr. Collinsworth might know more. That debt ratio, that's still very good for a municipality our size, as I understand it, right? So from an affordability standpoint, there really aren't any red flags.
Yeah, I was going to say, I remember we ran, I don't remember the numbers exactly, but we ran the scenario a couple of different times. We actually ran it with a higher amount of borrowing, and we were comfortable even with, I think, the $4 and the $4.5 million scenarios. Because we were assuming we were going to refinance the acquisition of the buildings as well, and we decided ultimately not to do that.
All right.
I was gonna ask Mr. Bream if he's comfortable with where we are in the process and with the ordinance, going into a first reading. He's our trusted advisor here with us every week.
There are not any legal concerns. I mean, I wish that the rates were still where they were in February of 2022. We had the first conversation about this project because we were comfortable where they are now. And I look at $1.7 million in interest being paid for this loan. And, that's not where we thought we were going to be. But at the same token, we look at over the lifetime and the history of the time that Chris and I, because I've started about the same time Chris did, I've given legal advice to the city and the village previously, and the rates are still relatively low. So no legal concern. I think we've got a great team assembled. We need the facilities for sure. This has been something that's been delayed for a long time. So at a certain point, you've got to go with what you have. We could look back 5 years from now and rates could be low again, or we could look back 5 years from now and be like, gosh, I'm so glad we did that when we did it, because now we can't. So, we don't have we can't act on hindsight. We've got to move forward, but I have no legal concerns.
Thank you.
So maybe to close this out, I would maybe just Dave Collinsworth. Dave, if you've got any general observations about the project, not necessarily the financing piece, anything you want to share as kind of the closing thoughts?
Yeah, just a few thoughts or observations. I think this part of the process I feel really comfortable with. I've worked with these two gentlemen on multiple occasions in my prior work life, and so I feel really good about where the city sits right here with this process, and where I think you're lining up in terms of the potential for your bond rating. I think this is the easy part as far as I'm concerned. They may not agree with that, but I do think the other piece is really the concern about what we're going to see, next week when we take bids. We got this little project up the street here in New Albany that's sucking a lot of oxygen out of the contracting community. So that's where my head is right now, is just a little bit of concern about, how many bids we're gonna get and what those bids look like. Because in the grand scheme of things, this is a relatively small project. So I would just articulate, just a little bit of concern with that. But I feel good about where we are at this point in time in the process, and I'll be happy to answer any other questions you may have.
Well, so I don't know if this is the right question, but so let's say we put out the bid and we get 0 responses, or we get something we're just not happy with. We're not committed to anything as far that nothing's been issued yet as far as the bond, or do we have it and then we're stuck making payments without any valid bids?
Yeah, you don't sell the debt until you sell the debt, and you'll know whether or not you've got a viable project before that. So,
Okay.
So that comes first.
Okay.
That's kind of why this process is ordered the way it is. So
In a worst case scenario, we don't get any bids, or we get nothing that is of interest. We can cancel, in essence, the whole.
you can put the sale on ice.
Yeah. Okay.
I mean, I'm not saying that.
Okay. Thank you.
Here's a good point, Mr. Collinsworth. Do we have strategies to address that? I mean, the local economy, to your point, there's very high demand. Contractors are being selective. I mean, the worst case is we don't have a bidding war and we're taking some high bid, but do we expect that we're going to have a bid? I just want to make sure we've got a project and folks that are interested.
Yeah, so we've got some generals that have taken out plans. And so we hope that those result in bids. It's hard to tell at this point.
Got it.
Yeah, I did talk to the architectural team today. They are reaching out to an additional contractor that we knew had shown some interest early, but hadn't necessarily pulled the plans at this point. So yeah, we are trying to gin up a little bit more interest in the project. But to be clear, the bid documents do say that the city can reject any and all bids for any reason, essentially. So
This might be a really strange question. I'm sure it is, but I want to understand the logic behind. We have a cash balance of $18 million and we're going to pay interest to borrow $3 million. Why don't we just use some of the 18 that we have and not have to pay interest on?
I'll let you.
I would say that would be a cash flow concern if we were to initially shell out a large sum of money to pay for a facilities project. Cash flow could become an issue. We are very healthy though in our cash balances, so that is a very interesting point.
That impacts our credit rating also. I mean, the better shape we're in, the better credit rating we get, right? So,
Sure.
Okay.
Also considering the projections for income tax receipts are projecting higher than we've originally anticipated as well. So having that income definitely stands to reason that we could afford to go into debt for a small amount for the facilities.
Yeah, I might add though, keep in mind, we've spent a fair amount out of cash flow already toward this project. So it's not like we've decided to finance everything. So I think we are trying to strike the right balance in terms of what to use cash for, and then what the longer term asset.
Yeah, I'm not complaining. I just want to understand the logic a little bit behind it. Yeah.
If I may add, a portion of that 18 million does include the sewer fund and enterprise funds, which those funds cannot be spent on projects such as this.
Gotcha. Yeah. Thank you.
I think this also just plays into our investment strategy a little bit. I mean, I know this is on record, but we're putting somebody else's money to work for us while keeping our own in a more fluid environment where we've talked a lot about, investing in securities and different financial vehicles that we can be more targeted. Aren't 20-year terms, where it's all just cash out of the door, where we can be selective in a 2 or 3, 4, 5 year investment as rates fluctuate.
Yes, and we are taking advantage of the higher interest rates right now with our Fifth Third securities, and Star Ohio is paying 5.3% on the 7 million that we have sitting in that bank account as well. So we are getting a good return on the other hand.
It's getting a higher rate of return than the debt we're planning to take out.
Thank you.
And you could also say we actually did use about 25% of the total cost.
Right.
If it turns out to be 4 million with the $1 million acquisition cost for the building, and we finance 3 out of that 4, we've paid 25% of our own money anyhow, so.
Right.
I would add, if council would indulge me on this issue, and that is that you are a rapidly growing community that will have future capital needs in the near term. So preserving some of that cash for that gives you some flexibility down the road.
One other question I was just thinking about. So what if 5 years down the road, or maybe 3 years down the road, if we go through with this, we have our bonds issued, we're working through that 10-year or 20-year plan. What if we wanted to go out and secure another 5 million, or go out to bid for another $5 million bond issue, say 3 to 5 years down the road from now? I'm assuming if everything stays the same and everything is managed the way it's being managed now with ratios and things, that we should still be able to secure a AA+ rating, right?
I'm gonna let Brian.
In other words, if we added something else to this in 5 years and we still get the same, are we likely to get AA+?
Yeah, the general answer is yes. And in fact, every time we go through this process, we will reconstitute the debt methodology to see what impact any new debt would have on your rating. But the general experience is as you grow over time and as you issue more debt, you typically do not get downgraded for new issuance of debt. The things that will impact your credit will be more on the financial side of things. So if you start systematically drawing down, for example, your cash, the $18 million, you start drawing that down, that will create concern for the rating agencies and could put pressure on your rating. So it has more to do, in my opinion, with the drawdown of your cash reserves. If we go into a recession and your income tax numbers go the wrong way, so currently they're kind of in a growth mode, but if for any reason we went into a recession and those income tax dollars started to shrink, that could be a cause of concern for the rating agencies. There's some concentration in income tax that the rating agencies don't like. And so those are the reasons that you would see the lowering of a credit score.
Very good. Thank you.
I think he brings up a good point on the growth, and I've heard that a couple of times. We've always played from behind. I mean, ever since I've been here, I'm sure Dave and Tim, you can speak more to it. It's like you're always trying to play catch up, but right now we're growing population wise at about 10% a year. I mean, that's outpacing everybody proportionally in the area. And this 2 years ago, income tax went up by 10%. Right now, we're up 19% versus the same period last year. I mean, we are outpacing everything. And I guess back to Brian's point, and I think my simple answer would be proportionally, if we're still growing and our cash balances are growing at a high rate and we're maintaining that, if it's proportional to our debt, then yeah, I think a AA+ rating is probably viable.
Yeah, the challenge will most likely be, you're going to continue to have population growth. You're going to continue to have income tax growth. With that population growth, you're going to have more services that you're going to provide at a higher cost. You're also going to need bigger and better infrastructure costs. And so managing the tax-based growth with a combination of cash and debt is going to be the way that you guys thread the needle with all of the new growth that you're going to experience. Right. And it really is, it's a balance, and you have to evaluate, how much debt can we handle? What if there's a recession? At the same time, you're looking at your debt. You're also saying, what's our cash position? And because the rating agencies if they see you drawing down on cash, that's going to worry them whether you're issuing debt or not. So just striking that balance, and the best way to do that are kind of what the city's practicing under your financial management. So if the city and council is updating and reviewing a capital plan every year, looking up 5 years in the future, what are we going to need? Then you start to slot out, okay, here are the infrastructure costs we can pay from cash. Here's what we can pay from with debt, in an effort to be really forward looking as your tax base expands.
Yeah, and maybe one other thing I would say is so that Brian and his team are helping us with this financing, but keep in mind they are serving as an advisor to the city as well. So, as these issues come up in the future, we'll certainly have a resource to bounce those ideas off of and make sure we're striking the right balance, as you say.
Okay, very good. Anything further, Mr. Hennessy?
No, that is it. Oh, Chris wanted.
Yeah, so just to close the loop on the earlier question, the bond ordinance authorizes the issuance of bonds. It doesn't obligate the issuance of bonds. And there are federal tax law issues that we pay attention to. There's a very big certificate that Dana will need to sign. We can't opine on a tax exempt bond issue unless we know we have a real project and we know what the real costs are. So we wouldn't let financing proceed if we didn't have a project or didn't have a good handle on what the costs were going to be. So there are checks and balances in the process, but that's why we're dual tracking this. And it's the bond sale date, which is the go, no go date. So that's still quite a ways away. And definitely after we get the bids in, after we've evaluated the bids, after we're comfortable awarding the construction.
Great, thank you very much. So, thank you, Mr. Chairman, for the opportunity. We're going to ask our guests, we're going to encourage them to leave at this point if they need to. I hope that what you hear is that we do have a strong team in place advising the city on this matter. So I think we're well positioned to move forward.
Very good. Thank you for coming. Appreciate all the information.
Thank you.
Thanks a lot.
Okay, we do have a few minutes left. We got a couple items on the agenda, monthly variance reports. Bank to book reconciliation, outstanding check register. I talked to Dana previously. And if you look down at the bottom there, we have the income tax report, and everything looks good. We're above plan. Ms. Steffen, what other remarks would you like to make?
Thank you. I would just like to make it known that we are 5/12 of the way through the year, and we've already collected more than half of our projected annual income tax. So that's looking very strong, and I expect that to continue throughout the rest of the year. I will have some appropriation adjustments to bring to your attention within the coming weeks, specifically surrounding engineering fees. Pass-through accounts. We've had to pay refunds to Pulte for some extra amounts that they haven't used for engineering. So we had to refund their money, about $62,000, which wasn't anticipated. So there will be, I'll be asking for an increase in appropriations for that as well. And some operating expenses for the street department do require some additional funds to be appropriated. So I will break those all down for all of you to see in the next couple weeks.
On the Pulte one, that they would have paid money and we're just refunding their money.
That's correct. Yes.
Okay, got it.
Hey, Dana, real quick question. So just not going through these line by line asking questions, but obviously we're ahead in some of these categories. We're behind in some on the income, on the revenue side, and on the expense side. But when it all evens out, we're still in a good shape as far as the total budget. Just some of these areas are some unanticipated events or maybe some categories we don't have much experience in, so we're still trying to adjust.
Yes.
Do any stand out that are alarming to you that say, well, this one really is missing the mark and I'm not sure why? Or
Not really. As far as the sewer fund goes, I will say we are going to have some repayments back to Pulte due to the agreements that were set in place several years ago on the tap fees that were prepaid. So I'm still going through the analysis on how we are going to pay them back and over what period of time.
Is that the 62,000 amount?
No, this is different.
Something else.
Something else, yes. It's related to the oversized sewer charge fees that they've paid on the,
Sunbury Meadows Pump Station.
thank you.
Oh,
Yes.
I know some of these percentages can be misleading because of the amount of dollars involved in those types of things, but so overall, though, we're still within our spend to.
We are, yes, and I would also note, which I didn't have it printed out here, but we have 5.8 million unencumbered in the general fund right now, which is higher than we anticipated at this point at the beginning of the year. So that's very healthy.
Okay. Thank you.
Was my non-financial background calculation. We budgeted 3.9 on the income tax. It's realistic that we're probably going to be coming in around $4.3 million on income tax.
at year's end.
Yes.
Well, that's percentages that increase.
This is
10.
just budget. This isn't even last year. I think we truly are 19% up year over year.
Mhm.
Sounds about right.
So we forecasted higher than last year and we're going to exceed it.
From an expense standpoint, from Mr. Grumney's standpoint. So revenue, we're up 19%. Any idea off the top of your head from an overall expense standpoint?
I don't have that. I don't have a number for you, but I could look into that. By fund would be the best way to go about giving you that type of information. I don't have the percentages, but I do have the flat dollar amounts to give you.
I'd just like to know that
Yeah,
percentage amount when you get the chance.
absolutely.
Just a couple of things to call out there. Wage increases. We had significant wage increases related to FOP negotiations and our medical insurance. Went up. I just can't remember the exact dollar amount. We can look it up by the next finance meeting.
Yeah, we can. I mean, the other thing is we did establish the HSA. There's some expense associated with that, but again, that's a positive. Hopefully people think in terms of retention of staff.
Mhm.
And we increased our streets budget.
Right.
There's some big
yeah.
hitters in there.
Right. Yeah, I was I'm sorry. I was just gonna say, and on the, I mean, another reason maybe why the health insurance piece went up as well, though, is we did have more people, I think, join the city insurance program as well, because it was a better alternate option for that.
Mhm.
I was gonna say, the one thing that stands out on this report to me is that we are still and always have been a heavily income tax dependent community. It's not unusual necessarily. We don't have a lot of corporate net profit tax. That's a very small percentage of what we bring in. So that's part of the diversification you're trying to get into with some of the, the long-term planning and the sewer expansion and things of those natures, trying to capture those opportunities when they come to the central Ohio area. But understand that these numbers are only what they are because, and our income tax rate is only as low as it is because we repealed the partial credit for people that don't work here.
Right. I totally agree with that.
And trust me, you need to understand that issue because somebody will come up to you and it seems it's a very attractive argument. And there are two sides to the argument. Why should I pay Columbus 2.5%? What's Columbus now? Percentage.
2.5.
2.5%, and then come back and pay Sunbury, and I don't work here. I have to pay it there and I have to pay it here, right? And you think, gosh, but on the other hand, why should the person who lives at 123 Dreamy Lane pay half of what the person that lived next door pays? We have the same expenses. They contribute the same to what we really need here in Sunbury day to day. To repeal that, and a lot of countries, counties and cities and municipalities have that type of a credit, but without that, our numbers would be very skewed. And it was a controversial issue when they did it. It's probably, I don't know, 16 years ago, 15 years ago, Dave,
Yes,
something like that.
yeah.
They did it.
Before, it was actually the year before I became administrator. And I did that in 2007.
Okay. So you're gonna go on 15 years.
Yeah.
It's a tough issue, but that's allowed us to retain a 1% income tax for everybody, right? And still maintain our revenues, retain our level of service. So again, I don't know that is an answer, but I think it's an issue you really have that contributes to this report and where you are and why we're able to do what we can do at 1%. So.
Mr. Green, when communities have reciprocity, does the money go to the municipality that they work in?
Yeah, so that's the thing. If really the laws were to change, what's fair is if they're only in Columbus 40 hours a week, but they live here and they use our streets and our municipality, our administrative services, our police, all of that, then why not get a credit from Columbus? Why does Columbus need to extract 2.5% from that person, the same as the person who lives there? They don't.
Right.
But the lobbies, the big city lobbies are not more powerful than lobbies for municipalities of this size. That, in my opinion, is the needs to change. Not taking the money from us so that we have less to offer and we have to put tax rates up for people.
So municipality XYZ that offers municipality, they say, it's okay, you live here and you don't have to pay us because you pay so much to another municipality that you work in but don't.
They collect less, but then they
Interesting.
have to figure out a way to bridge that gap. Nothing is free. They have to pay for their streets.
Thank you
too.
for
They have to pay
explaining
their
that.
administration too.
Because I've meant to ask that question to you because I've had people not just ask me in general, like, because it's an interest from a resident's perspective. It's a valid question.
Absolutely.
So
That's
thank
why
you
we
for
need to
explaining that.
Understand both sides of the issue.
Yes.
Right? If we give the credit, we don't have the money. Eventually, if you don't have the money, then how do you get the money? You increase the taxes on everybody. That's
Okay,
what has to happen.
that's interesting.
Either that or diversify the tax base and get more corporate taxes, which is tough.
Mhm.
You know, because we're competing with Columbus and everybody else for that type of business. But it's coming this way. And you guys are positioning yourself to capture it. It just hasn't been here to date. I mean, we haven't had the population, but we're about to, we're there.
Okay, thank you, Mr. Bringer. Got just a couple minutes left. Any other unfinished business?
Are we collecting the tree preservation fee from Rolling Hills and from Price?
We are, yes.
Thank you.
And does that get dumped into the parks?
The Parks Fund, yes, the trees,
Mhm.
and there's also an impact fee for parks, which also goes to the Parks Fund. Yes, they all go to parks.
Like to make a motion and say, let's go. Second.
Is that a motion for adjournment?
Yes.
Second.
Second by Mr. Grumney. Roll call.
Mayor St. John?
Yes.
Mr. Rumney?
Yes.
Mr. Capel?
Yes.
Mrs. Cooper?
Yes.
Mr. Martin?
Yes.
Mr. Ghost?
Yes,
6 yeas, we are adjourned.
thank you.